Today, Governor Lowe and the board met for the very first time in 2018 and they kept the cash rate on hold at 1.5%. So again, no surprises there. And the reason for that is obviously inflation numbers came out last week and the overall year-to-date number for 2017 was only 1.9%. Now we all know that they want to keep the inflation bandwidth between 2 to 3%, but we only saw in the December quarter a 0.6 rise in inflation, led by transport, education and housing costs going up. But of course, all the stuff that we're importing at the moment is getting cheaper and cheaper in terms of our technology and our sort of non-discretionary stuff. So that has obviously left the inflation figure at that lower point. Now I wanted to spend a minute with you and actually talk about historical inflation. So we've got some data from 1951 through to 2017. And I want to share with you some of the biggest and smallest quarters. Now overall, over that extended period from 1951 to 2017, the inflation rate has on average been 5.04. Now that's quite high considering we want to keep it lower than that. And that's the great job that the Reserve Bank has done with the monetary policy. So it's really incredible to see that that is now low, because higher inflation obviously means higher pressure on the household budget. Now, the peak was actually in the fourth quarter of 1951, where inflation was running at greater than 23%. Now, the smallest quarter in terms of the biggest decline was a negative 1.3 quarter in 1962. So they are big numbers, and it's interesting to watch how inflation has tracked over that longer period. So right now, globally and also locally, we've got record low inflation, which is obviously the reason why we've got also very, very low monetary policy and the cash rate sitting at record low levels. Now, overall, the Reserve Governor and the board have clearly said that is not the means for actually extending or increasing the cash rate, even though they're quite eager to get it off these record or what they might call emergency low levels. Now, part of that story is also around employment. Now, we saw a record number, just a fantastic number, over 400,000 people found work in 2017. Now, that's an incredibly good number, and the government need to be congratulated. Also, federal and state governments need to be congratulated on creating that many jobs. Now, the unemployment rate still sits at 5.5%, so it's still high, and we still have a sort of fairly high, underemployment number in there as well. So the Reserve Board are going to be watching that carefully, because broadly speaking, global economic news is really positive. We're seeing good numbers out of Europe. We're seeing the Americas doing well. We're also seeing Asia doing really well. So globally, there's a lot of confidence in the marketplace, and that has fed through to also, business confidence here in Australia and also consumer confidence here. So that is good news. So once we see inflation moving higher, and we also see that spare capacity in the employment market getting absorbed, we will see rates go higher. So that's the cash rate. But importantly, that doesn't mean that the banks won't move rates outside of cycles. We saw what happened last year in terms of changes around interest-only lending and also investment lending. Now, a new release of the Basel III paper came out globally, and there's some interesting reading in that is concerning to, obviously, me as an investor in regards to residential property investment. Now, what they do is they set risk ratings in different loan-to-value ratios. Now, loan-to-value ratios is the difference between the value of the property and the loan against that property. And those risk ratings are different to APRA's risk ratings. So we're now going to possibly see APRA come out and give their guidance around the LVR risk ratings. Now, the higher the loan-to-value ratio, the higher the risk rating, and potentially what they're talking about here is giving different risk ratings depending on the type of security and where the income's coming from to actually service that loan. Now, let me explain that. So obviously, if we get an owner-occupied debt, then the income to service that loan usually comes from working. Okay, but if we get an investment property, we've got income coming from the rent to help service that property. Now, what basically Basel III and APRA are looking at is how much of the rental income coming from that property is actually used to service that debt. Now, the higher the proportion, they're actually putting a higher risk rating on. Now that could leave the banks to argue that they could potentially increase investment lending, and that's concerning for us because ironically, and this is my most important point to all the bankers out there, is that the default rate in terms of the unservicing of those mortgages is usually higher for owner-occupiers than it is for investors. So yes, we obviously have seen more investors come into the market because they can see how great property investment can be, but it's also important to understand that they may be, sort of hitting us a little bit harder when I might argue that there's greater risk in delinquency rates in owner-occupied mortgages as there are in terms of investor mortgages. So that's one to watch. So even though we think the cash rate won't change, and if it does, it won't be at a large level, we also need to understand that that doesn't stop the banks from moving rates a little bit higher. So, as I've always said, make sure you've got a buffer. Make sure when you're doing your household budget that you can factor in at the very minimum, 100 basis points difference. So 1% different in the interest rate you're paying now, but more conservatively, it should be more like 2%. So don't overextend yourself in personal debt and personal household expenditure if you can't service that. Start putting that money aside, putting in the offset, building up that equity to look to make sure that money works for you in 2018 and beyond. Thanks for watching.